Max, who you want to call in?
Connor Boyton.
Connor, where's Connor at? Oh,
Back
there we
here.
go. I already forgot. See, the other Connor, don't feel so bad when I forget the elevator thing. Okay, do you remember what Max said about installment sales?
That they're in like chunks, like payments are in. I guess no.
You're on it. I was just letting, and the other thing I'll let you do is fumble about. Because fumbling about is thinking. Because what you just did is, I remember what he said, and now I'm having trouble articulating it, because the chunks piece of it isn't a terrible description. It's a payment stream that's going to occur over a series of years. Is that almost congruent with chunks? It is, right? Mine might have sounded a little better, but I've been around a little longer. Okay, so an installment sale is a transaction where the payment stream comes in over a series of years. Okay, and I think we even have an example of what we said the installment sale was. Okay, so Connor, how much gain is realized? And let me ask this question. What is realized and recognized? Do you remember that concept?
Recognized is when, for tax purposes, is when you're taxed on it, is when it's recognized. And then
Yep.
realized is when it occurred.
Yep, that's 100% correct. Okay. Oh, so here's this speech. I love this speech, especially for you people. Okay, is there's two things about making a mistake. Okay, one is when you make a mistake, you don't panic. How many mistakes have I made, Austin? Plenty, a lot. So panicking is wasted energy. The second thing you do is you say, what are my solutions? And 9 times out of 10, you're going to come up with a solution that either is a good alternative or it's something that's minimal damage. And then there's that dreaded 10th time. And that dreaded 10th time, you're like, oh shit, I really fucked this up. And the procedure there is, you don't hide. You pop up and say, hello, I made a mistake. Because the worst thing you can do is hide from it. It's just going to compound. The second thing you do is you tell the partner, the manager, the client, whoever. That's what you did, okay? Now, Austin, what's my bill rate, do you know? It's like $550 an hour. What's yours?
I don't know.
I don't either. It's 100 or 150? It's 150. Is 550 more than 150?
Yes.
Yes. Why do you suppose that disparity exists?
Because you have the expertise and experience.
I have the expertise. I like you. You know, you can write my bio. Okay? I know something, right? And you don't. Okay? So when you make a mistake, you know what that really is? It's learning. Okay? And when you make the mistake, you analyze why that mistake occurred. What was the problem that made me make that mistake? You own it, you learn from it, and you move on. Because the more you grapple with mistakes and the more you make mistakes, the more you're learning. The more you're comfortable and the more you don't make mistakes, the less you're learning. The less you're becoming the consultant that you ever so want to be. Okay, so don't panic. See what the solutions are. Don't hide from it. And understand failure is a good thing. Failing is a really, really good thing. How much have I failed? Plenty. A lot. And the ones that like, oh, that really hurt, right? That one hurt, are the ones that I learned the most from. Okay, so installment sales. How did I even get on that, Connor? I blame you. Installment sales, realized and recognized. Okay, what was realized?
When it occurred.
When it occurred, and recognized is
When you pay
pay
tax.
tax. Okay, so we have this realized gain where we got cash of how much?
0,
Property.
10,
And what was that property exactly?
land.
What was it?
It was stock, feature stock. I believe.
No,
No?
it was your promise to pay. You were
Oh, sorry.
right? It was a future promise that you're going to pay me the $10,000 over a 10-year period at $1,000 a year, right? So, and how much debt relief do I have, Connor?
0.
0. So my total proceeds, because I went through the full elements of my definition of proceeds. I got proceeds of 10, basis 1, a realized gain of 9. So the payment stream I said was how much per year?
1.
$1,000. What do I do with my? Oh, here we go. Okay, so there's a concept called the gross profit percentage. And I'm sure I put it in here somewhere. I'm talking ahead. The concept of a gross profit percentage is how do I know how to convert my realized gain into recognized gain when I receive the cash. Okay? So the gross profit percentage is simply gain divided by proceeds. Connor, who you want to call in?
Honor.
Connor, what's my gain?
9.
9. What's my proceeds?
10.
10. What's 9 divided by 10?
0.9.
90%, or 0.9. Either works. So in this case, I have a gross profit percentage. Austin, how often are they actually going to see an installment sale form in the first year?
It's common, but maybe it's
It's possible. It's more than possible. There's no promise that you're going to see it, but the level you'd be surprised would be 0. 0. Okay, so I know my gross profit percentage is 90%. So I get my first payment, year 1, for $1,000. I multiply that payment by my gross profit percentage of 90%. Connor, what's 90% times 1,000?
900.
900. So, of my realized gain, I now recognize 900 by virtue of getting that $1,000 payment. Okay? So, if this occurs for 10 years, if this occurs 10 times, how much gain do I recognize? 9,000, which ties back to the realized gain that we had on year 1. So they're going to make you harvest out a gain based on a gross profit percentage, and that gross profit percentage is total gain divided by total proceeds. Oh, yay. Let's do this, even though I've already said it. Jackson, who you want to call, or Connor, who you want to call in?
Matt Myers.
What you got? What's number 1 say here?
A completed sale of an asset where a seller transfers an asset to the buyer in exchange for a future promise to pay or note receivable is an installment sale.
And that's what we just did here, right?
Yep.
Okay. What's number 2 say?
What is the tax consequences of an installment sale? The recognition of gain is deferred until the seller receives cash from the note receivable.
That's basically what we've been saying so far, right? Are there any surprises so far?
No.
No. Okay. Well, let's do number 3, just for the hell of it.
How is the income tax consequence measured when cash is received? Form 6252, calculate gross profit percentage as follows. Assume sales price of 1,000 and basis of asset sold of 2,000. Then your gain calculation is your proceeds of 10,000 less your basis of 2,000, which gives you an $8,000 gain. And to calculate your gross profit percentage, you take your gain divided by your proceeds.
Okay. Any surprises there? Who you want to call on?
Let's go Max.
Max, what the hell did he just say?
He basically broke out the gain that you're going to have to recognize every year that you receive proceeds from that.
Okay. And it's just going to be a payment stream or chunks. It's a particular. Okay. So Matt, who you want to call in?
Let's go Carter Franklin.
Carter? Where the hell's Carter? Oh, back corner. Back corner Carter. Okay, what's this say?
How is the tax consequences measured when cash is received? Use the gross profit percentage to calculate the gain on the receipts of cash. Let's assume 10,000 is paid as follows.
So cash payment year 1 of 1,000, cash payment of year 2 of 4,000, cash payment of year 3 of 5,000. Does that give me my total of 5,000?
No, it gives you a total of 10,000.
What did I say, 5?
Yeah.
I fell asleep in the middle of my own sentence, 10. I was wondering why you were looking so confused. I'm like, you actually paused. It was almost like a wild animal in the middle going, oh, danger. Okay, so I was literally looking at him thinking, why is he so still? And it was because I'm stupid. Okay? Oh, you know what? Somebody could actually you said something stupid. Remember the gift card thing? You could have caught me, but you didn't. Okay, so 10,000. Right? So year 1 sale on the left-hand side, what's that doing, Connor?
What you mean, Carter?
Do it?
What you mean, Carter?
Yeah, what did I say?
Connor.
Yeah, nobody's going to get anything on names.
The year 1 sale, he received a cash payment and his gross profit percentage was 80%. So the income he's recognizing is 800.
Okay? What about 2 and 3?
Year 2, he received a cash payment of 4,000, same gross profit percent. He's recognizing income of 3,200.
Yep.
Year 3, 5,000 with a gross profit of 80%. He's recognizing 4,000.
Yep. So this reconciliation shows I started with total gain recognized somewhere, maybe I didn't do the gain calc, of 8,000 because it was 10,000 of proceeds versus 2 of basis. And it shows, oh, there's the gain calc right there. I'm an idiot. Then it shows a reconciliation of year 1 sale, year 2, year 3. Start with total of 8 of realized, recognized 800, recognized 3,200, recognized 4,000. I've now recognized everything by virtue of utilizing my gross profit percentage times my proceeds to recognize my gain as the cash is received. And look at this. We have the 6252. This is what you'll be confronting on the tax return when you have it. So if this top section is what is your contract price, and it goes through proceeds, and it gives you your basis, and it gives you your gain, and then this gives you your gross profit percentage, and then down here is reporting the payment stream. Okay, so let's take it line by line because Jackson looked like he truly was drinking from a fire hose as I was saying that. Is that accurate, Jackson?
A little bit.
Okay, so Carter, I almost called you Connor again. What was my original fact pattern on the previous page?
What do you mean by that?
What are the proceeds? What's the basis? What did we sell? What was the facts?
We received 10,000 of proceeds, and then gross profit was calc'd as 80%, which was just the basis minus
Okay.
the proceeds divided by total basis.
Okay,
So
so this 6252, this says year of sale. Okay, so how much was my proceeds, and what's the definition of proceeds?
10,000, it's your cash property, and then your debt relief.
Yep. So there's my proceeds, and this I hate this, and I'm not going to cover it. I need you guys just to tear apart at this form, because again, the more I try to express this, the worse it's going to get. And the only way you're going to be able to do it is just by playing with the form and trying to understand what's going on. Because debt relief on this form is a pain in the ass. That's why I left debt out of the equation. Do you agree it's a pain in the ass? Mm-hmm. It's a pain in the ass. Do you want to take a crack at explaining it to them? No. Okay, and the only way you really get it is by virtue of using and playing with the form. Okay? Do you think, let me ask this question, Carter. Do you think somebody that is intellectually curious and tears apart a form and puts it back together is going to be more or less successful than somebody that just sits on their ass?
More.
More, okay? So there's this concept of intellectual curiosity that says, wait a minute, that didn't quite make sense. And there have been times in my career, I'll give you two examples. One is I got a research project from Steve Kenny when I first got here. It was called Substantial Separate Equal Periodic Payments. Does that mean anything to you? No. Guess how much it meant to me when I had to look at it? About the same as it meant to you just now, except I have better points of reference in other areas to be able to go, okay, what makes sense? But literally, that we have the same starting point when he gave it to me. I was reading through stuff, literally drawing stick men, going, okay, this is what just happened. For every action, there's an equal and opposite reaction, and I now have to figure out how this works. And I just broke it apart, put it back together, broke it apart, put it back together. I wrote a memo, and we sent it off to some brother-sister firm, and thankfully, I got it right because somebody came over the top and looked at it. But I'm kidding you not. I'm drawing a stick man, reading through reg examples, going, okay, this happened, this person's here, and here's how this is interacting with each other, and here's the result of that interaction. I had to break it apart. And the other thing that, in terms of intellectual curiosity, is going back to that sailor exchange example where we have assets equal liabilities plus equity. If I'm hit with a concept, I will break it down into the most simple basic fact pattern and try to use a spreadsheet or something else to go, okay, here's how this is working. The first time I had to understand a tax accrual and how that works, which none of you need to know what a tax accrual is, but there's moving parts, and my ability to see those moving parts was practically zero. So I harvested data points and said, okay, how does this work? And the more I played with it, with a simple balance sheet to see how something went up and went down, and I kept bumping into walls. And every time I bumped into a wall, it was a reset. Okay, that I hit a wall. Now how does this work? So there's this level of intellectual curiosity to say, how does this work? And you do that by being intellectually curious, phoning a friend, saying, I don't understand what the hell's going on here. Because there's only, how many answers are there, Connor? 2. The correct answer, and I don't know. So anyway, this form, in terms of debt, I encourage you guys to be intellectually curious, okay? So line 1 is cash proceeds, and over here, this line 6, subject to debts and mortgages, that's where the debt comes in. And I did not want to mess with it, okay? Then it says, what's your basis? Come out, okay, so let's do this by line. Cost or basis is line 8. Depreciation allowed or allowable. What are you shaking your head for, Max?
There's none.
There's none, fine. However, the allowed or allowable, that's actually a good thing to bring up. Volume 2 is going to be talking a lot about sailor exchange and depreciable assets. So this depreciation allowed or allowable, in Volume 2, and this is going to be a preview into what's in Volume 2, there's sale of depreciable property, and we're also got another section here that talks about character of income. You have this concept of depreciation, and the concept of depreciation could result in, I'm going to say, this is probably not the world's best description, but 3 categories of income, okay? One is ordinary, either under 1245, which we're going to talk about that. One is 1250 recapture, which we're going to talk about that. The third, or the second category, is 1250 unrecaptured, which we're going to talk about that. And the fourth category, or third category, is 1231, and we're going to talk about that. Does that mean anything to any of you? It will, because we're going to hammer it. And that is really useful. And that piece of it is going to be really useful. So, with respect to installment sales, and I should have brought this up. Maybe I did. It might be in a future slide. Okay, so who was I picking on before? Or who was speaking before? Carter, who you want to call on? And we'll come back to this.
Matt?
Who?
Matt?
Matt. Okay, Matt, what was the example? What did we sell over here on the board?
Not sure. I believe it was land.
It was land.
Yep.
Okay, so installment sales are defined so far, and I did you a disservice because I made this too broad. We sold land, right?
Correct.
Which I'm glad it's land. Okay, so let me ask. Let's say that you have Matt, the investor, who has land. And you have Austin, the developer, who has land. Okay? And what a developer means is Austin goes out and replats a piece of ground into multiple lots and either sells those lots or he builds houses on those lots and sells them. Okay? He's a real estate developer. Okay? So that he's selling those on a regular and continuous basis. Okay? So does everybody know the concept of inventory? Does that feel like that's inventory to him, like this, if I was a dry erase seller, this would be inventory to me? Okay, it's inventory. So, but what's interesting is this is land and this is land, correct? So, and Jackson says to Matt, I'll buy your ground for $10,000, but I'm going to pay you $1,000 a year. Okay? He says to Austin, I'm going to buy your ground, I'm going to pay you $10,000 a year. So everything so far, the facts are exactly the same, with the one exception of what?
Mine's investment, his is inventory.
Correct. Okay? So where I'm going with this is there's certain categories of assets that you can't get installment sale on. Is inventory you cannot get installment sale treatment on. Once Jackson says, hey, I'm going to buy Austin's ground, that's a sale event. It doesn't matter that he's going to get that over 10 years. You, on the other hand, as an investor, can get that over 10 years. So there's a category of assets that you can't get installment sale on. And generally it's going to gravitate, that category is going to gravitate to ordinary income items. So with respect to, and we'll get to this, okay, this is if I'm going to change this to say this is a building and you have, no, can't be a building. It's going to be a car, okay? And you bought the car for $10,000, you depreciated the car for $2,000, and you have $8,000 of net book value. Cost, accum, net book value. Okay? So, the car's not inventory to you. The car is actually a capital asset, or not a capital asset, let's strike that. And you sell it for $20,000 because it's a nice car. It's a Tesla, I don't know, who cares? Okay? So this depreciation that you've taken on it, which is going to come out of volume 2, is an ordinary income event. So that depreciation that we're going to get would populate on this form to say depreciation allowed. And then it's going to force you to take it to the 4797 and treat it as an ordinary income event that is not deferred under the installment sale rules. Okay? So with respect to, there's certain things that you can't get installment sale treatment on, and those assets are generally ordinary income items. You can't get an installment sale on AR, you can't get installment sale on inventory, you can't get AR or installment sale on ordinary depreciation recapture. Those are the ones, do you know any more, Austin? AR, inventory, depreciation recapture.
Those are the three I would.
Okay, I can't think of anyone.
I always default to anything ordinary treatment, ordinary income treatment.
Yes, but back to there's a good professional, and then there's the people who know the exceptions. And then there's Code Section 1239 and 453 says you can't sell depreciable property between related parties unless there's not a tax avoidance purpose. So that would be ordinary. That would be an exception to what you just said. Okay, so we have $10,000 proceeds. You guys need to be intellectually curious about the debt. 10,000 of basis. So subtract the debt from that, which that's the piece I never understand, and it spins me in the ground every time. Compare it to basis. Then you're going to increase basis for the depreciation recapture. And then you're going to come up to your gain. And then your gain is going to give you your amount for your gross profit percentage compared to your contract price, 80%. And we collect our $1,000 a year every year. Or $1,000 first year, $4,000 second year, and $5,000 the third. So when we come down here, it says there was a $1,000 payment. The $1,000 payment results in $800, and then we have a $1,000 payment. This line says what payments were received in the prior year. What's the current year payment? There's the $3,200, and then there's the $4,000. So I don't know if this is something that you want to put a post-it on just as this is where the installment sale discussion was at. Just to remind yourselves, you can. This is your journey, but that to me, this seems like it might be worthy of remembering where this is at. Oh, look what I just did. Huh. All right. Who spoke last?
I did.
Who you want to call? Yeah. Hey, a question.
So let's say for an installment sale, like if you
Hold on. Here, just for asking a question.
so let's say in like year 3, they only give you a partial payment and then default on the rest of it. Would you have to restate like your gross profit percentage and change all that?
You know I hate you right now. You get one just for asking a question, being brave enough to ask a question, and that's a really good question. That's a really good question. Okay? So let's play with that. Because actually this happens all the time. And I won't get into the whys. Okay, so our facts, Connor, were that we had proceeds, correct? Of, well, let's just go here for a second. Let me back up a couple pages. Right? What you're saying, and I'm going to go back to the board here for in a second, is, wait a minute, I collected my $1,000 in year 1, correct? Is your question?
Correct.
I collected my $4,000 in year 2, correct?
Correct.
And now we're saying that in year 3, by virtue of some negotiation, bankruptcy, whatever, I get something less in year 4. Something's causing that to be less. So let's do it this way, because you're dead on it. And what number do you want to say you collect in year 4?
2,500.
2,000.
Okay.
I don't want my math to be too hard. You're going to collect 2,000 in the final year. Okay? So my proceeds were 10K, right? Basis was 2 and 8. Correct?
Correct.
So in year 1, we had 1,000 collected, correct?
Correct.
So, and we have a gross profit percentage of 80%, which resulted in 800 of gain, right? Which infers we utilized 200 of basis. And then in year 2, we had what, 4,000, right?
Correct.
Which had 3,200 of gain,
Correct.
correct?
Correct.
which infers that we had 800 of basis, correct?
Correct.
So if we now track my basis at time of sale equaled how much? 2,000, correct?
Correct.
Basis used in year one is how much?
200,
200. My basis in year two, how much?
800,
800. How much basis do I have remaining in year three?
1,000.
1,000. So now I get to utilize that 1,000 of basis and results in 1,000, and my gross profit percentage, in fact, changes from 80% down to 50%. Okay? And why I could have just stopped and said, well, wait a minute, I got $1,000 of basis left over, because in your fact pattern you said, well, it's year three, terminal point of the transaction. And I took the next step to make the point that it went from 80% to 50%, because that gross profit percentage based on transactions can change in the middle. And it changes in the middle because there's a concept of, and again, this is something that just as awareness doesn't matter, where I say, Connor, I'm going to buy your business for $10 million. And you say, no, it's 15. No, it's not. So you and I get into a discussion on what this is really worth. I say, I'll give you 10 million in currency today, hard cash, and the rest is going to be an earn-out. And as long as the company meets a certain level of earnings, I'll pay you the 5. If it doesn't meet that certain threshold of earnings, you just get your 10. It's called contingent earn-out. So in that case, you would have proceeds of 15 million, basis, I don't care, of 7.5 in a recognized gain, not realized, right, Connor? Of 7.5 for a 50% gross profit percentage. But unless, in general, unless that contingency, that $5 million contingency, you have to develop a springy set of shoes that can launch you to the moon. That's the only way you're going to get it. Okay, that's ridiculous. That's never going to happen in a trillion years. Okay, you could say, that is so ridiculous, so provably ridiculous, I'm never going to get it. You could use 10 for your proceeds and have, 67 or 75% or whatever the number is, 75% gross profit percentage or whatever, however that works. Or it went the other way. Doesn't matter. Okay? But if there's even a monicum of probability that you're going to be able to earn that $5 million, it goes into proceeds and bumps up your gross profit percentage to make you recognize gain earlier because your gross profit percentage is larger. And then once, well, I told you, this wasn't good, it didn't do what it's going to do, so now you don't get the $5 million. So now I do this calculation that says, what basis have I utilized so far by virtue of the payments? How much basis do I have left over versus the proceeds that I'm going to get, and what's that new gross profit percentage? That happens not all the time. It happens more than zero. Happens enough for me to be able to articulate what it is that happens. That's a really good question.
Can it go negative, your gross profit percentage?
Nope. That's another good question. Okay. I don't know if it's card worthy, but okay. So let's talk about that. What do you think that means? That it'd be negative.
Like if they in year 2 instead of year 1 said that they couldn't pay it all back, and so in year 2 we had 1,800 of basis left, but they say we can only give you 1,500.
Okay. That's going to be a loss, right? That once that happens, you're in a loss position. Okay. So this is another good thing to know, and this might actually be worth taking a note. We're going to go into the Wayback Machine for a second. Let's see. Sam, how old were you in 2012?
11.
11. I love it. How does that make you feel? Okay, 11. So let's say that I have $1 million sale. December 31st, 2011. My basis, I'm going to make it 1.1 million. And my basis is $100,000. And my gain is $1 million. Okay, and we're going to get that in the payment stream. Okay? And that payment stream is going to be paid in the worst, the most extreme. 100% is going to be paid on January 1st, 2012. There's a 1-day span. There's a 1-day difference in the payment. Max, does that meet the definition of an installment sale?
I don't know.
Do I have a payment stream that is occurring over more than 1 year?
Yes.
Yes. So even though there's 1-day difference, I have a payment stream that is occurring over a year. So now I have the ability to defer that gain into 2012. And do you think that happens, Max?
Yes.
Do you think we might every once in a while plan not to get the payment to defer the tax into the next year? Yes. Okay. Is it super common? Not uncommon. So
You'll see with escrows.
do what?
We'll see with escrow accounts.
Escrows, yep. There's lots of things, lots of examples. Okay. So why did I say 2011 or 2012? Austin, do you even have a clue why I picked that year?
I was still in high school that year.
Okay, which is fine, because there's only 2 answers, right? The answer and I don't know. So let's talk about the tax rate. It was 15% federally in 2011. Okay, 150,000 of tax federally. Okay, but if we receive that $1 million, or have that $1 million gain on January 1st of 2012, well, son of a bitch. 1 day later, it's 23.8 or 238,000 of tax. When 2011 rang in as a new year, Obamacare tax, the 3.8% net investment income tax, was now inflicted on the gain, and the federal rate for capital gains went from 15% rate up to 20%. So there's almost a 9% increase in the tax that occurred or was inflicted, and there's only 1 day difference between those two. So, what am I driving at, Max? Do you suppose? And you probably don't know.
Just be smart with planning with your clients, know what is going on in the, political world, just to understand differences in tax treatment.
Okay. So do you think there'd be an opportunity? Do you think that you're required to report the income on an installment basis?
I don't know.
No, you're not. So what you could tell a client is, hey, you opt out. Even though you didn't receive the payment till the next year, opt out. And if you opt out, then it's going to save you, almost 100 grand tax, whatever that number is. Okay? Installment sales are not mandatory. They can be opted out of. And the way you opt out is by not reporting it on Form 6252. You just take it straight to Schedule D. Sam, do you know what Schedule D is? No. Okay. All right. For those keeping track, will you go to the internet and pull up Schedule D for me, please? Because, these points of reference, I think, are good. Does anybody know what a Schedule D is?
Capital gains and losses.
Capital gains and losses form. You do, Jackson? Okay. So you just go to Schedule D, and we're going to pull it up, what it looks like. And this is the form you go to report your gains and losses. Okay? So, and yeah, while you're at it, can you pull up the 8949 or whatever the hell that form is? Huh. Okay, so let's go back to Schedule E quick. Go down to the, okay. Nope. I want this section. What the hell? Okay, so you would come here and most likely report it. Is D the one? Which one has the no basis reported with the IRS code? I can't remember. Okay, it would be an E or F. You just say, okay, my basis, my proceeds were $1 million. My basis was 100,000, and you'd report your $900,000 gain here, even though you have the opportunity to report it on the form 6252 and defer the gain. So if you reported on the 6252, hey, in year one, I sold this for $1.1 million. I populated line 1 or whatever it is on the 6252 with $1.1 million. I do go through the gross profit percentage, which says it's 90%, roughly, gross profit percentage. And then the 6252 says, how much cash did you receive this year? How much cash did you receive this year, Allie? On December 31st, 2011, how much cash did you receive?
Nothing.
0. So now you put a placeholder in your tax return, the 6252, that says, I am now putting you on notice, IRS, that I've entered into an installment sale, and I got a future gain that's going to be reported to because I have a realized gain, but not recognized because I haven't got any cash. Okay? And then Schedule D, under that scenario, would say 0 gain because it's all deferred because we haven't received the cash. But if you opt out, you don't do the 6252, you just report on line 9 your $1 million of proceeds, compare it to your $100,000 basis, have your $1 million of gain, and you opt out. That's the opt-out procedure. And the other thing, let me ask this question. If you get to, let's say that this transaction occurred in December of 2009, and this was my last payment that was going to be received. And this tax rate change is coming, but I entered into the installment, or I used the installment sale rules to defer the gain. Do you think that the IRS is going to say 3 years after you've deferred gain, tax rate's changing, do you think they're going to let you go, well, wait a minute, we'll let you report that gain in 2011. You think they're going to let you do that? No. Once you've opted into the installment sale arrangement, you don't get to opt out of it. You're stuck with it. And if you, can you go back and amend?
No, can.
I think if you take installment sale treatment at first, I don't think you can either. I think you're right. So if anybody's intellectually curious, you might want to look up whether you can go back and amend after you elect installment sale treatment. I don't think you can actually, because there's only two. What are the two answers, Carter?
I don't know the right answer.
And right now, I don't know. Right? I don't know whether I can opt out or go back and amend to opt out. I don't think you can. Okay? All right. We go back to the. Okay. What assets can a taxpayer defer? I see. Yeah, I do a good job sometimes. Okay, so this is actually a page when I say it's worth marking. It might be worth marking. You know, what assets can a taxpayer defer the gain on sale of assets, capital assets, stock, land held for investment, self-created goodwill, 1231 gain, land held for business, building, purchased goodwill, sure. What assets are you not allowed to inventory? Assets that generate a loss, okay? So that's the inverse of what I just told you about whether you opt into or opt out of the installment sale, installment sale rules are not available for loss. So if I change my fact pattern to say that this is 1.1 million of basis, and I actually have a $100,000 loss, installment sale rules are not available to you. You just take the loss. 1245 recapture, 1255 or 1250 depreciation recapture, which is different than unrecaptured 1250. Okay? Gain on sale of depreciated property between related parties, except the exception we noted earlier, tax avoidance purposes, as long as you're not doing it for tax avoidance purposes. And what else? Okay, let's see, Jackson, what's my little one say there?
We're going to spend a significant time on these rules in this training. However, as a quick example, based on the sale of an asset with acquisition cost of $10,000 and accumulated depreciation of $8,000 with net book value of $2,000, sold for a $12,000 note. It breaks it out, I guess, with all those facts.
Okay, so you
Shows the ordinary.
Yeah, you do your normal procedure, saying 12,000 of proceeds, and you broke that down between cash, debt relief, and property received, because we never shortcut it except when I do, and I'm different. Do as I say, not as I do. Basis, you get a gain. That gain is broken down in between 1245 and 1231. The 1245, you can't defer that gain. It's recaptured in the year of sale. Now, with respect to that particular rule, commit that one to memory. Because what are we doing, Chris?
Drinking from a fire hose.
So, and we have to pick pieces that we want to pick up and remember by virtue of all the data that's coming at us, knowing that depreciation recapture does not get deferred under installment sale rules is a good thing to know. That's worth knowing because you're going to see installment sale rules or installment sales a fair amount of your career. And I still bump into that rule and forget it. So don't be me. Depreciation recapture is not deferrable under the installment sale rules. Oh, look, we talked about that. I do this all the time. Jackson, who you want to call in?
We'll go Luke.
Luke, what's this say? What's number 8 say? 8 and 9.
If you opt out of installment sale, does that mean you're reporting and being taxed on income you have not received cash? Yes.
Okay, what's 9 say?
Why would you do that? One example was tax law changes in 2012, the capital gain tax rate increased. I started tracking myself by about 9%. If the taxpayer sold an asset in 2011, that generates about $1 million gain, and payment was not received until 2012. The deferral was sold.
What did I say? Oh, the deferral is silly. Okay. So this is exactly what we just did over here. And I included a state rate in this calculation where I didn't include a state rate up here. It's the exact same thing. That's a big difference.